Yeah, you can hear. Can you hear me? I'm here.
Yeah, hi. Something odd was happening with the audio, but yeah, I'm in.
Right, can you hear me now? Right. Can you hear me, gentlemen? Michael, Sam?
Yes, I can hear you.
Yeah,
Yeah,
perfect. So I
yeah.
just had to change devices because I use my laptop for the live streams and one of my phones for the actual call because it makes it easier. So we're here now. Good afternoon, everyone. Thank you very much for joining us. This is our 11th UK Startup Finances Q&A, and we're here to hopefully help some UK startup founders with your finances. Now, what that means is we're going to have a quick introduction, then we'll open it for questions from the audience. Sorry, scrap that. First, we'll have some introductions, then I'll be asking the panelists for do's and don'ts that are important when it comes to early stage finances. And then we'll start taking questions from the founders on our call here on Microsoft Teams, in terms of hopefully helping you understand your numbers better and obviously manage your finances better. There are no wrong questions and there's no need to be shy. It's a learning curve for us all. In terms of how this works is once we've gone through the introductions and the do and the don'ts, those of you that are here on Microsoft Teams, all you have to do is drop your question in the chat. We'll give you the mic, you introduce yourself, and then fire away with whatever question you have. Those of you who are on the live streams, whether you're on LinkedIn, YouTube, Facebook, or Instagram, please bear in mind that unfortunately we're unable to monitor your questions there live. So if you do want to ask us anything, you'll have to join us here on Microsoft Teams. And the quickest way to do that, it's to go to our website, startuptoscaleup.club. Again, it's startuptoscaleup.club. You scroll down a little bit, you'll find today's session, which is Startup Finances Q&A number 11. You click join. It's a quick registration on Luma, and there you'll find today's link. And when you're there, and you find the link, then simply click on that link to join us here on Microsoft Teams. Being audio only, it means that you can tune in from anywhere via any platform or device. And when you're here, then again, simply drop your questions in the chat. You can ask us anything to do with finances in the UK, cash flow, budgeting, profit and loss, payroll, employee benefits, perhaps some taxation too, bookkeeping, VAT, auditing, maybe even R&D tax credits a little bit, loans, banking, fraud, your projections / forecasting, maybe some ideas and some kind of must-have templates and all that jazz. There literally are no wrong questions and no need to be shy. We are, however, only going to be here for the next 54 minutes. So if you do want to ask us anything, my advice is to do it as early as you possibly can and not leave it for last second. Now, if your questions today, though, are on other matters and not finances, please save them for the other conversations we run. For now, we do talent on Mondays, product and tech on Tuesdays, growth on Wednesdays, fundraising on Thursdays. Second Friday of each month is UK Startup Law. And third Friday of each month, as you can see today, it's UK Startup Finances. That all from 12 to 1 p.m. UK time. They're all available on our website, startuptoscaleup.club. Now, without further ado, let's get on to some quick introductions. I'll go first, then Harriet, then Samuel, and last but not least, Michael. Please, my name is Anton Call. I'm your host, and I'm an Albanian in London working with startups normally right after they get investment. I embed within their teams and help them hire and keep the right people. I also do some growth advisory work with a few other startups and some accelerators and help angels and family offices with their due diligence and assessment. Harriet?
Hello, I'm Harriet Formby. I'm a fractional CFO and chartered accountant. I run Below the Line Finance, fractional CFO company, and I support startup scale-ups, more mature businesses, essentially to grow well, to navigate cash flow and all of the things that come up around funding, financing, and growth, and work in a range of industries from tech, creative, professional services, and I've got a background as well in sort of manufacturing and other things, so quite a range of different topics.
Is it me? Is it? Excellent, I'll go. Hi everyone, my name is Samuel Ajala. I'm a chartered accountant and managing partner of Arthur Hammond Accountancy and founder of Scale Up CFO. I work as a fractional CFO for startups and scaling businesses, helping founders get clarity on cash flow and just to stop nasty surprises and actually understand their numbers so that they can scale profitably. Look forward to answering as many questions as I can while I'm here. Thanks for having me again, team. Thank you.
Hi everyone. My name is Michael. I work as the financial controller at Black Sea Ventures. I work in VC. Black Sea Ventures is a VC firm that invests in startups and at the pre-seed stage, typically with very, very early valuation below 2 million or so. I also kind of work as an advisor to some founders and so forth, but in a non-official capacity.
That is amazing. Thank you very much to all three of you. I think we can perhaps look into some do's and don'ts. I'm sure you've seen some good stuff that you might have been impressed, but I'm definitely sure you've seen a lot of bad stuff and horrible stuff that we founders get up to when it comes to our finances. And maybe if you can help us and put us out of our misery a little bit with some basic, like really fundamental do's and don'ts, we'd appreciate that. So if we can maybe start with Sam on this, then Mike, and last but not least, Harriet, please. At least one do and don'ts. You can go for more if you like, but whatever you do, don't use the same logic for those opposites, please.
Fantastic. Thanks, Anto. Number one, do prioritize cash over profit. What you'll find very early on as a startup is cash. Cash keeps you alive, and not your P&L. So what you need to do is be profitable and still run out. You can be profitable and still run out of cash, right? So for me, number one is prioritize cash over profits, without a doubt. And number two, don't. I would say, especially early on, don't hire too fast. Don't hire too fast. What I found with a lot of startups, that headcounts actually kills a lot of startups even faster than marketing. Honestly, I've asked the question, why are you hiring this? And it felt like the right thing to do, as opposed to actually being the right thing to do. So just be very careful about hiring too quickly when embarking your startup journey. Thank you.
And yes, Mike.
Yeah, sure. I guess building up on what was just mentioned when focusing on cash, build yourself a rolling cash forecast if you can, even if it's scrappy. Just have something that's rolling, that's forecasting for, let's say, 12 months. So you kind of give yourself an overview of what your expected outgoings are, at least the ones that you know guaranteed are going out. And then you can also kind of update, and then be sure to look at it and update it as you're moving along, which is hence why I said rolling, so that you're just keeping an idea of where your money's going, how you're spending things, and therefore where spending needs to go up on a certain item or spending needs to go down. One would say do management accounts and look at your things on a monthly basis, but definitely have like a rolling cash forecast.
So for my do, I would say do talk to, I've noticed in a lot of the Q&As we have, there's co-founders, so there's multiple people running a business. So I'd really recommend talking about with your co-founders, and that is everything from sitting together and looking at the monthly financials to talking to each other about how you feel about where you're at, how much you're making, the risk, and so you understand each other's perspectives. Because I know a lot of businesses fail. Yes, it's to do with cash flow and financing and that sort of stuff, but it's also to do with being able to have early conversations about money together. And then for my don't, I'd say don't early stage try and perfect things too much. There used to be quite a popular thing about the lean startup model, which was about kind of getting things done scrappy and quick and test it to market. I see a lot of people wanting to say, like, build bespoke platforms before they've actually tested the market, and there's a lot of money then that's getting tied up in doing something that maybe isn't quite right and needs to be iterated and scrapped in the future. So really trying to prove commercial viability and that there is demand for this stuff as quick as possible before you spend too much money would be what I'd recommend.
That is some amazing advice, and thank you very much for that. I guess three things quickly. Number one, over 90% of startups fail, and the top three reasons for that are: one, market fit; two, running out of money; and three, not having the right people. But when it comes down to it, from what I've seen in all my years within startup land, and we're talking over 20 years, both as a founder and working with others, is that unfortunately most of us aren't that great at finances. So hopefully we'll be able to help you with some of that today. Number two, whilst we've been doing the finances Q&A for just over a year now, exactly actually 1 year, we've been doing other Q&As for 4.5 years, almost 5 years, and we've had about 290,000 people tune into our sessions, and none of that would have happened without people like Harriet, Sam, and Mike. So if you panelists would like to drop your LinkedIn URLs in the chat and maybe a couple of words about what you focus on in terms of helping startups, please feel free to do that. And the others, please feel free to follow them. And before I go to our first question, I'm especially keen on Michael to think about this, but also the others. And Mike, the reason why I say especially you is because of your VC sort of investment hat as well. Most founders that I come across, when it comes to that data room and preparing pitch decks and what have you, the number one thing they always seem to ask for help with is the forecasting. They have no idea what a forecasting looks like. They don't know where to get templates. They don't know who to knock on whose door to knock to do it, and so on. So if you've got any tips on that, or even better, if you can think of any templates that people can easily find and do that, and the others as well, please feel free to do that. That would be great. But first, maybe we'll go on to a question that was sent in to us, and then we'll circle back to the forecasting. So this is from someone in they're near Manchester. She says, conducting internal audits without dedicated resources. We are a SaaS startup providing HR software to other SMEs. We're based near Manchester. And then the question basically is, their challenge, rather, shall I say, or what they need help with, is that our startup lacks a dedicated finance team, making internal audits difficult despite investor demands for robust financial governance. We are preparing for Series A funding. And the question is, how can an early stage SaaS startup like ours conduct effective internal audits without a dedicated finance team? Are there UK specific tools or third party services that specialize in startups? And how should we prioritize areas such as revenue recognition, expense tracking, and compliance with UK GAAP to meet investor expectations whilst keeping costs manageable? I've looked them up, managed to find her, and I can see, at least on LinkedIn, there's 4 people. Although I'm not sure exactly how big the team is, but from what I can see on LinkedIn. So maybe we can start with Michael on this, then Harriet, and last but not least, Samuel. Take it away, team.
Sorry, that was a long question. If you could repeat that, please. So I'm reading.
Of course, yeah, of course. It's in the chat as well, but I'll read it out loud. So if you look at the chat, you'll be able to refer to it. But the question is, how can an early stage SaaS startup conduct effective internal audits without a dedicated finance team? And then she asks, are there any specific tools or third party services that specialize in startups? And how should we prioritize areas such as revenue recognition, expense tracking, and compliance with UK GAAP to meet investor expectations whilst keeping costs manageable? She's preparing for a Series A raise. Are you able to access the chat, Mike, to see?
Yeah, I'm just reading it now. But I mean, what I would say is, I mean, we have people in this chat and on this panel who could literally do that for them as a service. I'm pretty sure fractional CFOs or I mean, I would with regards to tools, I believe my esteemed panel could probably advise a bit better. But yeah, I believe there's definitely people they could reach out to who offer such services, who could support them. And if they already have investors, it might be that their investors could potentially point them in the correct direction. Most of these investors, be it VCs or even angels, will probably have within their network finance professionals who, for a particular fee, would be able to come in and help them set up their back office in a way that would allow them to, one, be able to view it, two, maybe potentially be able to update it going forward themselves as well. So yeah, it's definitely looking out and seeing where they can get that service externally if they don't already have that internally. That would be my advice.
Thank you. So it's Harriet and then Samuel, please.
What I'd recommend is, first of all, and obviously not knowing much about what the setup is now, is the basics that you should have in place. I'd say for sort of any business ideally, but for definitely if you're raising an investment, is appropriate checks that are done on a monthly basis. So you need a finance routine happening on a monthly basis that ensures that, you know, you're doing certain checks as you go. Now, the reason for this, obviously, as you found, is so you don't have surprises that come out of the woodwork later. But what we're talking about here is things like revenue recognition. You know, do we need to make any adjustments in terms of cut-offs and deferred revenue and that sort of thing, to make sure that we're recognising things in the right period? We want to check essentially everything on the balance sheet that is like a control account, like wages and taxes. We want to make sure that those have got a reconciliation behind them so that we know they're accurate, and the banks are reconciled, the bank feeds are correct, and they're all coming through. So there's like a checklist that essentially would feed into your management accounts, and having good documentation that, I think the accountants call it working papers usually. It's maybe not a term that's familiar to founders in the same way. And that would be essentially to document everything. So every balance that is there in your financials has got workings behind it that have been checked. And that would be, I think, foundational to having confidence. And then you can have conversations where you're confident about the numbers and what they mean, and there's no errors in them. And this is something that if you haven't got it in place, you could certainly bring somebody in terms of like a fractional CFO. I don't know if they necessarily call it an audit, because an audit tends to be a specific thing that is a regulated thing, but essentially to do a check of this and to say, let's have a look at your accounts and let's have a look at your documentation and advise you of a routine to bring in sort of going forward, but also to catch up with everything and go through. Essentially, it's checking that all of the balances have got workings and, you know, detail behind them so they're defendable. And this, I'm not too sure about the question about if there's software or any particular, you know, tools that you can use for this. You can go a long way with just having good documentation, which is usually in a, you know, Excel document or Google Docs, Google Sheets type of thing. But yeah, if you've got more complexity around revenue recognition, there's definitely tools you can use for that help you post that information and make sure it's accurate. So that would be my starting point anyway.
Fantastic. Not much more for me to add from what Harriet said. I think my only small contribution to the question is, for most early stage startups, I think internal audit, it doesn't really mean building like a finance team. Some of these investors are well versed with the kind of businesses they meet, and they don't expect anybody to have a large finance team or anything else like that. But all it just means is just showing some level of control and consistency, something that is usually a miss with startups. Usually with a lot of startups, there's a lot of money being spent, but no accountability to where that money is going. I think this is where some of the challenges are with investors. So I think my advice is just to focus on high risk areas investors actually care about: revenue recognition, cash, compliance. Where all of these things going? Where are you as an organization? And so I would say have a clear written down policy. Do your monthly bank reconciliations. Don't work to the end of the year to get it done. Just do these monthly. it may seem tedious, but something like this really can take about half an hour to an hour a month to get these things done properly, right? Especially with things like bank fees that feed straight into some of these softwares. Which brings me to my next point: is just to review your expenses regularly and keep a record in one of those accounting softwares I mentioned about, like Xero or QuickBooks. These are very common softwares out there, and in most cases quite easy to use, especially when you're not being treated with too much complexity. Right, it's very simple just to post certain expenses and incomes in there as well. Right, and then every quarter you can just bring in an accountant just to do a management report for you and review it. And so what I've just told you basically is a written down policy. Follow that process, and any investor will be willing to invest with you. All they're really looking for is visibility, discipline, and some confidence in your number, and that you're not making it up. That's pretty much what they're looking for in a nutshell. Thank you.
Thanks a lot, team. Going back to my initial question, Michael, any thoughts on these forecasts that often investors look for founders to have when they approach them for investment? You, as somebody who works within the field, especially, I'm sure you've seen a lot of founders who don't actually really know much about finances. Are there any templates out there so that they don't have to end up paying Samuel and Harriet for a template, but rather save that money for Samuel and Harriet to come in for some other stuff, more important stuff? Anything you've come across, or is there anything that you advise the people that approach you?
Yeah, certainly. I mean, I was going to say, with regards to templates, there's a dime a dozen all over the internet. Even if you use platforms like OpenVC, where they will literally help you run through pitch decks, they'll help you run through financial model templates. And then there are other advisories. There are places, for example, it really depends on the stage that the company is at, because most of them not, for example,
I'm thinking mainly early stage, because you're absolutely right. There is so much out there online, but sometimes that is a problem because you don't know which bleeding template to go for. That makes sense.
Then yeah, I would say probably platforms such as OpenVC can provide templates that are quite good for the early startup company. We're not expecting to see the most major detailed financial forecast. More often than not to disparage anyone, not to be rude, but more often than not, things change, things pivot, and sometimes the numbers, I mean, they shouldn't be, but there are times where the numbers are high in the sky, and people just kind of come up with stuff that they hope that they can do, and then sometimes they are based on actual kind of factual events that are taking place. But yeah, I'd say platforms such as OpenVC can really provide a lot of beginner information and templates that can help the startup companies.
Thank you very much. I don't know if the others wanted to add anything here. If there is, please feel free to. If not, we can now maybe a quick reset of the conversation and then move on to the next question. Yeah, go on, buddy.
I'll add just 2 pence in there. At some point during this course, sorry, I was just in the middle of sending an email. I'll send a link to a forecast that I had that I can share with us. There's plenty of them.
That is brilliant. Sam, can I ask you a favor? If you look onto LinkedIn, I've tagged you onto the live stream there, because I think that there it's much better in terms of exposure. Because most people will end up looking at LinkedIn rather than go through the chat here. So even the people I've noticed, even the people that look at the recordings, they don't really spend a lot of time in our chat, if that makes sense, after. So probably it's easier for people to see it on the LinkedIn live stream if you get a chance.
I'll do so.
Thank you.
The other thing I would say as well is, if somebody wants to create something like this from scratch, right? I don't I think a lot of accounting, in terms of anything with numbers, has a way of scaring off founders or entrepreneurs. But really, what you're simply doing, in essence, is you're downloading your bank statements or activities you've already done in Zero for the past 12 months. If you've kept your good records on Zero, you'll be in a good position to do this, right? You look at your income month by month over the past year, right? And what you do, you now repeat it moving forward. Now, obviously, we're going to be scaling at a point. You're going to continue the percentage point by which you've scaled in that first year. But if last year you saw that you made maybe £50,000 in January, then you know that this year, then you should be hitting over £50,000 or more, right? And that's basically all you're doing. You're just looking at what you've done previously, and you're now predicting what's going to happen in the future, right? In a nutshell. And you do the thing for your expenses as well. How much did you pay on your phone bill? How much did you pay towards staff? And you extrapolate that for the next 12 months moving forward as a prediction. Now, planning the year ahead, you already know whether you're going to hire new people. And so you will now add these additional costs into your spreadsheet to say, right, based on last year, we anticipate the cost of employees are going to increase because we plan to hire 2 more people. And it's literally that simple. It really is. It's not complicated at all. I know people like to run away from numbers, but all you're simply doing is taking information from the past to kind of predict the future. That is it in a nutshell.
Thank you very much for that. Harriet, did you want to add anything, or shall we move on to the next one?
I think I just briefly add the thing that I think is most important with forecasts is to make sure that you're capturing the drivers. So, for example, revenue. We want to show it's, by product or offer, price point, and number of customers. It's the build up. So it's not just saying it's 10k a month or something. It's saying it's 100 users at £100 or whatever, and then this is how we got to the figure. You want something that you can tweak the underlying assumptions, like change the number of customers and the price, and it will automatically update. So that's all I'd add, is just make sure that you've got clarity in the model on the drivers of cost and revenue.
Here, thank you very much for that. Right, a quick reset of the conversation for those of you that have just joined. This is Startup Finances Q&A. It's our 11th session. We're here to help you with whatever questions or challenges or clarity that you may need in order to understand your startup numbers better and hopefully manage your finances, your business finances successfully. For those of you that are on the live streams, whether you're on LinkedIn, YouTube, Facebook, or Instagram, please bear in mind that unfortunately we're unable to monitor your questions there live. So you'll have to join us here on Microsoft Teams. It's an audio-only call, which means you can tune in from anywhere via any platform or device. You can either click on the links that you see on those live streams, or simply go to our website, startuptoscaleup.club. Again, it's startuptoscaleup.club. You scroll down a little bit, you'll see today's session, which is Startup Finances Q&A number 11. You click join. It's a quick registration on Luma. There you'll be able to find a link for our Microsoft Teams call. And then through that, obviously, you can join us and tune in here. Once you're here, simply drop your question in the chat. We'll give you the mic, introduce yourself, and then fire away with your question. Now, your questions today, they can be on anything to do with finances. I mentioned earlier, there are no wrong questions and there's no need to be shy because it's a learning curve for us all, but they can be on things like cash flow, budgeting, profit and loss, payroll, employee benefits, taxation, bookkeeping, VAT, auditing, R&D tax credits, loans, banking, maybe invoice financing, fraud, projections, forecasting, and all that jazz. But if you've got questions on other matters, save them for the other events we run. Monday's Talent at the moment. Tuesday's product and tech, Wednesday's growth, Thursday's fundraising. Second Friday of each month, it's UK startup law. And third Friday of each month is UK startup finances, as you can see today, all from 12 to 1 p.m. UK time. And they're all available on our site, startup2scaleup.club. Michael, if I can kindly ask you, if you wouldn't mind, that amazing link that you just posted, if you don't mind doing that on LinkedIn, so you'll see I've tagged you on the live stream there. I think it will be more founders that find it there rather than in our chat here on Microsoft Teams. But without further ado, I think it's time we go on to our, what is this, third question? Yep. So this is about preventing vendor fraud during rapid scaling. And by the way, team, you can refer to the question in the chat once I read it out loud for the live streams. They're a clean tech startup trying to develop eco-friendly packaging solutions. They're based in Cardiff, and the challenge is they're onboarding new suppliers quickly to meet increased demand, but there's concern about fraudulent vendors providing substandard materials. So the situation basically is generating revenue supported by angel investments. Okay, well done. So, question. As a clean tech startup scaling rapidly, how can we safeguard against vendor fraud during supplier onboarding? What UK specifics, due diligence processes such as companies' house checks, credit risk assessments, or supplier certification verifications should we adopt to ensure legitimacy whilst maintaining speed in our supply chain operations? This is a really good one. I often ask startups to check before they even call somebody for potential business, and that's just clients, to do credit checks and stuff, let alone suppliers. It's easier said than done because most of these credit checks, they cost quite a bit. But I'd love to hear from the team. So I think in the last one we started with Michael. So maybe this one we can start with Harriet, then Samuel, and then Michael, please. Take it away, Tim.
So there's obviously kind of a couple of ways this might happen. So they could be an out and out fraudulent outfit, in which case due diligence up front, checking out that they are who they really say they are and verifying that they're a real company's house, etc. I think doing a Google search is good to see what the reviews are like and see what other people's experiences of them is useful as context as well. And there's that side, making sure they're a real company. If they have got those like ISO accreditations, then there should be a bit more around that. If they are actually kind of certified in various things, then obviously check that is legitimate, and that should give you some confidence. Then in terms of protecting yourself from the risk of poor products being sent, you want to have a good process essentially to make sure if they, for example, if they're invoicing you and you've got, ideally you'd have some credit terms so that the goods come in, you check the goods, you verify them to like your purchase order, so a good sort of system in terms of how you manage orders and goods in, if you've got like your own warehouse or something, and then they're only paid once you've kind of ticked them off and said, okay, yes, we received 1,000 units of whatever that thing was, and then you've got a process to then pay it. And then obviously making sure that you've got good checks around the bank account. Essentially then it's just the payments process, so that you're not paying people until you've checked the goods, if they'll give you credit, and that might be difficult if you're early stages, but hopefully that's something you can build in, and that you've got good checks to make sure that that's all legitimate and you're only paying for what you've had, and that essentially you can check the quality. And then presumably once you've worked with them a bit, you can probably start to trust them more in terms of the quality of the goods. But it might be that you get, I know you said you're moving fast, but perhaps you slow it down a bit and you get samples and you meet with them and you kind of suss it out that it is, they might think it's good quality, you might think it's rubbish, it might not actually be defective, it might just be not good enough for what you want. So I think you may want to slow down a little bit on that and do some quality checks, but that's probably enough for now. I'll let the other guys go.
Is it me to go next? Sorry, I think I must have missed that. I'll go next.
Yes, please, Samuel. So yeah, so it's you and then Michael, please.
Fantastic. I think it's something like that. It's just to put simple supplier onboarding checklists in place. We had just last week, a major client of ours had fraudulent activities take place. And it's a project that we actually helped them to set up and install within their organization. It's a large organization, so it's not a startup, but I think the same things will apply. Now, for somebody of this size, a startup, I think there's a few things that I would do. I'll verify companies on Companies House, actually ensuring that they exist. I would confirm bank details independently and require signed contracts or purchase orders before any payment is released, right? I think it's absolutely necessary. If at all, you can pay for the service after it's been provided as opposed. I know some organizations will ask for deposit up front, you know. So these are the things you can consider. I think for higher value suppliers, I will add potentially a quick credit report or background check just to verify certification where relevant. In this organization we did some work with, I think about 2 weeks ago, is actually making sure that people who say they're VAT registered are actually VAT registered, and that was something that was very major with this organization. So when we speak about suppliers list, so that I don't scare anybody away, it's simply this, right? Especially if your team are working remotely, if you need somebody to do something, there will be a database within your organization. It could even just be a spreadsheet. And what you're doing is, to get more office paper in or stationery, we always contact this person because we have fully vetted and verified this person. The challenge of just finding anybody on the internet is that you can't vouch for them. So the idea is that to take half an hour in your day per month and just to verify all of your suppliers, just to make sure that they're verified. So most fraud happens when startups are moving so quickly, hence the term scaling, that they can't take half an hour to 15 minutes just to verify certain steps. So please, those 15 minutes or half an hour is something worth investing, and just make sure that the people that you're working with or you're doing business with you are who they say they are. Thank you.
Thank you very much. And just before we go to Michael, two things. Number one, you mentioned, Samuel, about independently verifying the bank details. If you can think what's a cheap, i.e. a free rather way and quick way to do that. And two, I'm glad you mentioned that, 15 minutes time. As somebody who's been in some form of recruitment or HR for a very long time, one of the first things that you learn is that most companies nowadays have what they call a PSL, preferred supplier list.
Yeah.
And that works with various stuff, not just recruitment, but most sort of procurement departments and companies out there will have that. And well, sometimes it can be a hindrance if you're not allowed to go outside that PSL. But most of the time, I agree with Samuel. It's good to have people that you've already checked. And guess what? I'm not looking at this, unfortunately, from a financial and fraudulent point of view. I'm looking at this from a business point of view, in the sense that if you have a system where there's a PSL, you are more likely to get more favorable terms from preferred suppliers and say, look, we'll only deal with, I don't know, just for argument's sake, 3 or 4 suppliers in this particular field. Therefore, I want better deals. And these potential suppliers, and they're more likely to give you a better deal when you're in that boat or in that way of managing things. And yes, so just before we go to Michael's view on this, Samuel, any ways of kind of independently checking bank details of potential suppliers?
Yes, of course. For bank details, I don't actually have any particular software, but Do you know what's actually good about some of these modern day bank accounts? That when you're transferring money for the first time, they now begin to ask you quite a number of questions. Did this person ask you to make this transfer? Have you met them? Have you done your due diligence? So on and so forth. Even to the point that where you're making a transfer and their names don't align, it flags it up even before making the bank statements. So this is something that's quite common. You can utilize that. Most, whether it's Monzo, Starling, Bank, most of them actually have it. Online banking. Before you make a transfer, it poses some questions, especially if it's the first time you're making those purchases. Obviously, companies have just type in the company or the company name number, and you get the name of the company. There was an incident with a client of ours where they did that and they realized that the company they put in there was actually dissolved and no longer exists. So immediately that brought up a red flag. Most of the softwares that we use, even as a firm, we have anti-money laundering. We have quite a lot of things that are inbuilt into our softwares. So I think some of the softwares, especially as it relates to finance, would have a lot of these things that are inbuilt. And as well, you've got the VAT. I think you could just go online and check whether a company is VAT registered or not. So yes, it's they're out there. I hope my piece of advice has helped one or two of us. But yeah, they're certainly out there. So please just utilize it. Do your research on the internet, and they're certainly there to verify who it is that you're trading with.
Here. And by the way, we'll go to Michael, but if either of you three can think of, is there a risk? Let's say when you're a startup and you're not, one of these big girls and big boys of the world out there, is there a risk if you have engaged with a somehow fraudulent supplier? Can the law or the tax man come after you and have a go at you for not doing proper due diligence and checks and stuff? Or are they a bit lenient when they see that you're a newly startup with not enough people and so on? But in the meantime, if Michael can give us your view, please, Michael, on the question itself, that would be great, buddy.
I mean, it's pretty hard to kind of add anything in addition to what Samuel has already mentioned. Definitely with regards to your checks in advance, kind of with what we deem to be callbacks independently taking place, adding that to your checklist. So before you even issue payments, make sure that your checklist has been kind of fully completed and it's there. So, for example, in places that I've worked, although it does seem like a long process, it is an important process that we have that checklist on the back end of every payment that we make, so that we know, was a callback needed? Tick yes or no. If you paid them before, if it is needed, then that it's been done. That you've probably not just called back the number that's on the invoice per se, but you've kind of gone online, managed to find an independent person who wasn't the same person who sent you the invoice to begin with, so that you can kind of verify through different means. And at least that way you've had more than one touch point with the company before you issued that payment. As with most payments, although this isn't necessarily the case if you're a one-man band in your company, but if you are in a big enough company, kind of having one person who prepares and another person who approves, and so that way things are kind of done and there's kind of separation of duties and independence in that aspect of things. But yeah, pretty much everything that Samuel mentioned is by and large what advice I would provide.
Thank you very much for that, team. Now, Harriet and Samuel, in terms of what you've seen happen out there, does the lawman and the tax man really kind of come like a thunder down on you if you get this wrong when you're a startup, or are they a bit lenient when people don't have the right checks on suppliers?
So really it's I mean, the first thing you want to do is try and get the money back from your bank, to recover the loss. The next thing is, I guess, you want to say, so you've lost 10 grand. You probably want to try and at least expense that against your corporation tax bill, is possibly part of the question there. And essentially, if it was a genuine, there's nothing reckless or fraudulent in your own company, it was a genuine scam that's happened to you, and you'd taken reasonable steps, then actually it is allowable against corporation tax. I mean, it will be case by case, looking at the facts around the situation. But if there was very little you could have done to stop it, as in there was no intent on your side, then you can at least set it against tax. I'm not sure they necessarily have a view. I mean, I think it's just accepted that unfortunately people do fall victim to fraud, like in private individuals, companies. It does happen, and it's all about, really, I guess, whether you're complicit in it or not. And if you're not complicit in it, you're on a victim, then it's obviously very different than if you're somehow part of it, and that's obviously a very different story. So I think that's probably as much as I would sort of say probably comes into it. I mean, if I think that's probably all I'd add, but it's not something that I've had a lot of involvement with.
I hear you. Thank you. Sam, did you want to add anything, or shall we move on to the next?
Yeah, we can move on.
Good man. Thank you very much.
Thank you.
Thank you. So this one, identifying non-deductible marketing expenses. This I get wrong all the time, and also most of the founders I come across do get wrong as well. So versions of this, we probably have received 1 billion questions, but I'll read it out loud. It's in the chat for you to refer to, so I'll read it out loud for the live stream. So identify non-deductible marketing expenses. They're a MarTech startup specialized on influencer marketing analytics. They're based in Leicester. The challenge she has is we have incurred significant costs on clients, entertainment, and sponsorships, but my co-founders and I are unsure which expenses are deductible. So the situation is that they're post-seed funding, they're generating some revenue from SaaS subscriptions, and again, the question in full is, as a MarTech startup, how can we identify which marketing expenses, such as sponsorships or client entertainment, are non-deductible under UK tax law? What specific guidance from HMRC should we reference to categorize these costs correctly? And how can we structure our internal expense policies to avoid overclaiming on corporation tax returns and other stuff? Maybe if we can start with Samuel on this, please, then Michael, and then Harriet.
In terms of expenses, HMRC doesn't usually allow tax relief on things like entertainment. So you're entertaining clients, taking them to lunch, even if it's for business development. However, with sponsorships, it's usually allowable if there's a genuine advertising or brand exposure and return. I think the key here is really documentation, invoices, contracts, and a clear description of the purpose behind the pay. Internally, what I would recommend is that an organization like yours, like theirs, they should set an expense policy that literally separates the marketing spend from entertainment spend. So it's coded correctly in your account. So if you go into Xero or QuickBooks, one of the first things you find there is when setting up is to set up your chart of accounts, and it's just a list of different accounts where you post all of your expenses to. And so before starting off, clearly identifying your organization and identifying the various expenses you're going to encounter. And so when you set it up, you will realize that some are deductible and you could set it up in a way whereby once you allocate it, some are immediately tax deductible, others are not. So entertainment, even if you spent it through your business, it wouldn't be tax deductible. So just to make sure you don't overclaim on your corporation tax return. That's all. I hope that helped. It was short, but I hope it helped.
No, thank you. And just before I go to Michael and Harriet, either you, Samuel, or the others, if you can clarify this. So to take clients out, i.e. clients entertainment, is no longer allowed by HMRC. But let's say if you sponsor a lunch or a breakfast or something along those lines for advertising purposes, that is allowed. Is that right?
Yes, absolutely. And there's clearly something in return. So what usually would happen like that is that there will be something in return. And even when with the marketing, in all of the promotion of the event, you see your company logos, then the idea is that after the company event, you get some more client inquiries. Something like that is tangible, something like that is traceable, and something like that is allowable.
I see, but you can't do too much of that, or do they frown up on it, or that's fine?
It's tax deductible. As I mentioned beforehand, as long as you can document it and justify it, right, then it's allowable. You understand? Because you have to understand from HMRC's perspective, they're not too concerned about what you can necessarily spend as long as it's justifiable and it's for the purpose and whole. I think HMRC describes it as wholly and specifically for the purpose of you doing business.
Makes sense.
So,
makes sense.
yeah.
Thank you very much for that. Michael, Harriet, what are your thoughts on this question?
It is a very nuanced question. It will be different for every client. There, like Samuel said, for some, maybe a safe thing to do is kind of say, okay, client entertainment, well, it is, but yeah, blanket ban and say that is just non-deductible. And then with some of the sponsorships and so forth, sponsorships are allowable, hospitality isn't, so you have to be very specific. So things such as paying for the publicity, the demo costs, brand materials, etc., is fine, but they're non-deductible. The catering, the bar tab, and some things like hospitality, I think are deemed non-deductible as well. So it is quite nuanced, and it's best to kind of, as Samuel said, one, put a policy in place to kind of work out specifically, okay, so that if anyone's referring to it whenever you're next doing the next event or so forth, okay, this element of things are deductible, these elements are not deductible. Whoever's doing the bookkeeping, if you do have an internal bookkeeper, from the receipts, definitely kind of splitting out the receipts so that they can book correctly the tax deductible expenses and the ones that are non-tax deductible. And yes, as Samuel said, just being able to kind of justify what you are deducting and your reasons why.
Okay,
but yeah, it's typically safe. So I was going to say it's typically safe to have a very kind of hard stance on it, just so that you don't fall foul, as opposed to, I guess, trying to live in that grey area.
Just before going to Harriet, so how on earth do these larger companies that give black Amex cards to their senior people justify that? Because I'm sure they don't do it and then just suffer the consequences. I'm sure they are somehow deducting it against something else. How does that work? Any of you want to pick that up?
Yeah. So in most cases, there are expenses that are allowable. I think we should be very careful. We're not necessarily talking about entertainment. And in most cases like that, C-suite managers that are giving these cards, you'll find in most cases, not all the time, I don't want to say all the time, but in most cases, these are individuals that travel regularly And when traveling regularly, there are certain expenses you can claim, right? So obviously, if you're going away from work and you're usually stuff like lunch or breakfast will be covered or dinner will be covered. Your transportation to where you're going will be covered. And so it will be reimbursed for you using those black cards by the business, right? So it's not necessarily entertainment. Entertainment is more so you're going for client meetings and you're paying for somebody else to have a meal. It's not necessarily will be acceptable. And also, just to add as well, something that is common is that a lot of people do this and put it through their books anyway, if I'm going to be honest with you. And that is not the right approach. That's not the right approach. And if caught, could be an issue.
I see. No, I only mentioned that because I've seen it myself on various occasions with larger companies where I was either a client or somebody advising them, and they would just use the company card. But I hear, Harriet, any thoughts on this question and also on my question, or you want to put them together? So I think however you want to go about it.
There's sort of two sides. So one thing is what you can deduct against corporation tax, which is obviously nice because we want to, to do that and reduce our corporation tax bill. But I think here what's more important sometimes to think about as well is if you're in an industry where to get work, you have to take people out and entertain them and buy them dinner and drinks, which this sounds like it is, it's probably better for you as a business to spend that money, take them out and have the work, and then not, okay, fine, you can't deduct the costs, but you get the work in because they then work with you. It's a really funny one because this is my personal opinion, so it's not me talking as an accountant. But I think it's very unfair that, activities that are for your business to get work in, then aren't deductible. And I understand that, why it is, because it's like alcohol and, all of that sort of conversation. But at the same time, it's some industries, this is what you have to do, and you're not going to have any customers if you don't go out and entertain people. So I think what's important to remember is we're talking about, okay, it's not a corporation tax deductible thing, but it's still a business expense. So entertainment is still a business expense. So in your accounts, it's still an expense. It's just that for the corporation tax return, it gets disallowed and taken out. So it's really important to categorize things at that level so but it is a business expense. So when you're talking about staff that are expected to go and entertain clients, they can expense that and have it reimbursed. It's not out of pocket for them, but they're not able to get the money back. So you can still reimburse people for that stuff. There are obviously caveats that, it goes into like anti-bribery stuff, isn't there, about if it's extremely excessive and, all of that stuff, especially if it's international trade. But if we're talking about trade shows, dinners, award ceremonies and drink, that sort of stuff, yes, there's going to be stuff there. And some industries, it's just a cost, and that's how it is. It's then whether it's a business expense that's allowable for corporation tax or not, but the person that's bearing the cost, so the employee that's going out with their company card and they're having to buy rounds of drinks because that's what's expected in the role and that's how the business works, that's not out of their pocket. That's still going to be, they're still going to be reimbursed for it. It's just that the company can't claim the corporation tax, claim it against corporation tax, but it's not out of their own, taxed money, essentially.
Makes sense. Well, thank you very much for your brilliant advice today, team. We are 3 minutes over the line, so apologies, but I think it's time we wrap this up. If you've got time for parting words, I'd appreciate that. So maybe we can start with the lady of the house, Harriet, and then Samuel, and last but not least, Michael. Please take it away.
I would just say, thank you again for having me, and it's really good to join the others on the panel as well. And I just say, take one thing away from this conversation that you can kind of start to work into your business, perhaps, and that will be, really productive use of the time that we've had together.
Thank you, Harriet.
Brilliant. Just want to say thank you, everyone. Really enjoyed today's session. Really enjoyed the comments from my co-panelists. Really appreciate that. If there's one takeaway, is that finance doesn't need to be complicated. It just needs to be clear, to be honest. When founders understand their numbers, and this is my experience, that when founders understand their numbers, decisions in that organization become a lot easier. And if decisions are becoming easier, then growth becomes a lot less stressful. Right, so get a hold of your numbers, try to understand your numbers. It's not as daunting as it may first. Just get hold of it. Believe you me, it will be for the betterment of your company. So I appreciate being part of this panel and wishing everyone the best as you scale your startup. Thank you.
Also similar, appreciating the panel and the advice that's been provided, and also to those who have joined this call on whichever platform you've joined on, because I think for me it's important that you take accountability of your numbers. I think that's my one takeaway, that taking accountability of your numbers is really important. It's one thing to have your business idea and to kind of try and move forward with it, but more often than not, if you don't clean up the house, so to speak, then everything goes awry, and far too many founders have been on the wrong side of that. And so, for taking the initiative to join a meeting like this, an event like this, and wanting to kind of have those kind of things at the forefront of your mind is really important. And thank you to everyone for attending.
Thank you very much for that. I think I've been sharing the video without meaning to for a while, but thank you for that, team. By the way, from February, we are now going to move to all our sessions being monthly sessions instead of weekly. So we'll have a startup to scale up week, basically, on the second week of each month. It will be more of a sprint where we'll try to package and equip startups with everything they need to have in order to go from startup to scale up. And if either of you three are kind enough to join us again, if I can kindly ask you to maybe next time, if you can bring some detail in terms of how it works with incoming changes of HMRC and the stuff on finance and taxes, that would be great. I'll ask you next time. But for now, huge thanks for your help today. I really appreciate it and look forward to seeing you next month. Now, as far as my parting words are concerned, just remember the startup journey can be both exciting but also quite challenging. So try to have some fun in the meantime and be kind to yourself and everyone else for that matter too. Otherwise, have a great weekend. Hopefully we'll see you on Monday for Startup Talent Q&A. Thank you and God bless you all. Bye-bye for now.